Today is June 21st, 2026. It is 7:11 p.m. Pacific time as I'm recording the video. And Solar Edge Technologies, I believe, is the perfect proxy chart for the Boyle Heights and warehouse commercial solar insurance thesis, because the chart here has been ripping off its May lows to the tip of the trough for a 608% in gains on a massive roaring rally to the upside, while the macro tape just handed us a new tail risk narrative. And to be clear, I am not saying that solar edge equipment caused the Boyle Heights fire, where the public reports I found say that the fire started on the roof of a large cold storage warehouse with solar panels, involving a ton of hazardous smoke, and officials that are now dealing with ammonia and hazmat issues, where the cause is still under investigation, as AP has now reported that the warehouse roof was a solar panel covered roof, and that the residents are now being told to shelter in place because of the hazardous air concerns. And The Guardian has now reported that the fire has now persisted for a total of 5 days, with California now ushering in an emergency resources all around the state that are now involved. But here now for the bearish stock thesis, the point is not that Solar Edge Technologies has caused this fire. The point is if commercial rooftop solar starts getting repriced as an insurance, fire, and or hazmat or liability risk, the entire solar hardware trade, I believe, gets priced into a new multiple compression problem. And because this chart throughout the span of time on a multi-year rally has now become the definition of a stock that technically looks beautiful, but now might be walking straight into an ugly macro narrative. And the narrative is that if commercial rooftop solar may no longer be a green energy asset, it may become an insurance underwriting question, where officials will come out to start saying that it could become a warehouse risk question, and it may become a firefighter access question. And if and when this happens, Wall Street will not just price in revenue, Wall Street will ultimately price in the liability. And here we are knocking on the door of the 50-day moving average. You have a nice clean 52.97 price support level, and what I would like to call a nice clean head and shoulder classic looking top formation. And that has meaningful head and shoulder DNA written all over it. Well, the chart now is bouncing off the 52-53 handle and correlation of the 50-day moving average, and I believe that that level is everything. The neckline to the head and shoulder classic looking top here, where this former resistance has now become support, and the trend is still alive for the bulls here. But if and when Solar Edge Technologies loses the neckline and the 50 moving day average in confluence, I believe this starts to look like a failed breakout after this violent vertical solar squeeze. And when breakouts fail, you get a lot of trapped longs at the top of the trough, and the broken industries can ultimately get violent. Technicals aside, fundamentally, Solar Edge was already in a wounded turnaround story, where the company reported Q1 2026 revenue up 46% year over year, and management talked about a sixth consecutive quarter of margin expansion. But the revenue was still down 7.4%, and the company still reported losses. So the bull case is that the worst is over, where margins are healing, revenue is recovering. Solar Edge is technically coming back from the grave. But the bear case is if this company is fighting through a damaged solar cycle, an inventory hangover with margin pressure and competition, and now that the commercial rooftop solar may get hit with a new insurance risk narrative, then that, I believe, could be a knife twist. Where reports had stated that the roof was covered with solar panels, a massive cold storage warehouse that has been unleashed and hard to control, where officials are now dealing with the smoke, the hazard concerns, and a huge industrial facility that has now become a public health problem. Again, and I have to make this clear, I am not saying that Solar Edge caused it, But markets don't need a court ruling to start repricing the risk here, and insurance companies will not wait for any YouTube traders to bless the thesis. They only look at fire history, roof access, electrical systems, the battery storage, and some of the hazmat exposure that will ultimately have a domino effect into the public health liability. And then they will come out and say, what is the premium now? Because if I'm an insurer looking at a massive warehouse with solar panels on the roof, I am asking a massive amount of questions, like how can the firefighters access it safely, to what if this roof catches on fire? Can they ventilate? Can they cut off power? Is there battery storage? Is there ammonia refrigeration? On and on and on and on. And if the answer is we don't know, well, then the insurance premium has to skyrocket. But once again, it'll be a clean 16% crash down to the primary ascending uptrend price support level off the April major reactionary lows, and that has a plethora of reaction all across that span of time. Call it a multi-year primary ascending trend line of price support, and bull traders and long traders will ultimately have that in confluence of the 200-day moving average. So watch out, where short sellers and bear traders will ultimately look for a solidified breakdown red infused candle close below the 53 handle, call it the 52.97 price support. But make no mistake about it, as for now, the ball is in the court of the bulls here, and it is a technically strong chart with a healthy pullback here, but with a dangerous new narrative risks, where I believe the bears have the macro story. And if California starts treating the warehouse solar like a liability, this entire trade could become reprised. The insurance market starts taxing your business model. The chart throughout this span of time can look bullish right up until the multiple gets burned off the roof.